Ladies and gentlemen, good day and welcome to MTAR Technologies Limited Q4 and FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Irfan Raeen from Orient Capital. Thank you, and over to you, Mr. Raeen.
Thank you, Nirav. Good afternoon, everyone. On behalf of MTAR Technologies Limited, I extend a very warm welcome to all participants on Q4 and FY23 financial discussion call. Today on a call, we have Mr. Srinivas Reddy, sir, Managing Director and Promoter, Mr. Guneshwar Rao, sir, Chief Financial Officer, and Ms. Srilekha Jassi, Manager, Strategy and Operations. Hope everyone had an opportunity to go through our investor deck and press release that we have uploaded on exchanges and on company's website. I would like to give a short disclaimer before we start the call. This call will contain some of the forward-looking statements which are completely based upon our beliefs, opinions and expectations as of today. These statements are not guarantee of our future performance and involve unforeseen risks and uncertainties. With this, I hand over the call to MD, sir. Over to you, sir. Thank you.
Thank you, Irfan. Good afternoon to everyone. I would like to thank all of you to spare a valuable time to participate in Q4 2023 earnings call of MTAR. I have with me Mr. Guneshwar Rao, CFO, and Srilekha, Senior Manager, Strategy and Operations, and Irfan from Orient Capital. We have uploaded the investor presentation in stock exchanges, and I hope all of you have reviewed the same. At this point of time, I would like to mention a little bit more on the market guidance given by us in terms of revenues and margins, what we had said earlier. In terms of revenue, initially we had given guidance of 55 to 60%, and during the Q3 earnings call, we had revised our guidance to 75 to 80%. We have achieved revenues of 573.8 crores in FY23 as against 322 crores in FY22, which is 78.2% increase, and we have delivered the guidance revenue number as mentioned. For FY24, we continue to confirm the annual revenue guidance of 45 to 50% increase in revenues on year-on-year basis. When it comes to EBITDA margin, we had initially given a guidance of 30% plus minus 100 basis points, and revised the EBITDA margins during the earnings call of Q3 2023 to 29% plus minus 50 basis points. We have ended the year with EBITDA margin of close to 27% instead of the guidance given at 28.5%, which is on the lower side by 1.5%. I owe the shareholders clear explanation regarding the lower EBITDA margins compared to the guidance given. One is the gross margins in Q4 has come down to 48.6% due to sales mix as, or you can say the product mix, as clean energy reported much higher growth compared to the other segments. As we all know, clean energy gross margins are lower than the other segments. But this cannot be the reason because the operating leverage should maintain our EBITDA levels in Q4, which did not happen, and eventually the annual guidance margin was down by 150 basis points, as Q4 recorded 25% EBITDA margins. The impact was purely because of employee benefit expenses, which has increased by 10 crores quarter-on-quarter basis, because we had to implement market corrections in salaries for across the board for high-skilled workers and our core engineering team and our management team during the quarter, and the same was doing with elders. This had impact of about 5% in EBITDA margins in Q4. If not, the margins would be 30% in Q4, and eventually we would have realized the 28.5% EBITDA margins for the year. The strength of MTAR is the high-skilled employees on the shop floor, the core engineering team, and the management team, and this has been done keeping in mind the high growth prospects of the company moving forward, which we are really excited about, and strongly believe that this one-time benefit will lead to a strong foundation for a growth company like MTAR, the way we are looking at it at this point of time.
Sir, sorry to interrupt. You are losing your audio.
So in spite of the above, the overall employee and other expenses dropped in percentage terms from last year to this year by 540 basis points and 14 basis points, respectively, which now stands at 15.8 and 7.7, respectively. Moving forward over the next 2 years, the employee benefit expenses will fall below a single-digit percentage in comparison to sales. The above move did impact PAT, which should have been at 110 crores, which is now close to 104 crores. Finally, I would like to inform all the shareholders that this decision would lead to much better performance moving forward, and the team has the passion, but it was high time to pass on this benefit to support the passionate team, which was done without the team asking for it. We would like to confirm that our annual EBITDA margins for FY24 would be around 28%, with around 28%, I would say, with few basis points here and there. Due to steps already taken towards the steps which are very critical at this juncture is reduction in costs in terms of supply chain activities. Obviously, the employee benefit expenses would drop, and also the reduction in other expenses that we are looking at, and a substantial increase that we are envisaging in the current year in terms of product sales, which will be more than 120 crores, which is a massive jump compared to the previous year. When we look at our order book, we have given a revised guidance in Q3 earnings call for rupees 1,400 crores of closing order book, and we have ended with 1,170 crores, which is very close to the year-end order book guidance given earlier. Based on the orders expected and execution of existing and new orders during the financial year, we are expecting the order book to be at rupees 1,500 crores by end of the current financial year FY24. We are not only expecting huge orders from clean energy segment in fuel cell, hydel, and waste to energy, wind sectors as well, as we have done enough first articles during the past 1 year. And also in the aerospace sector, we have already started working with reputed MNCs. Especially, we also received a letter of intent from GKN Aerospace in the aerospace sector for close to $10 million. The expected order inflows should be around 1,200 crores in all segments put together in the current financial year, which is very encouraging for us. And a lot of effort has been put in, not only in terms of achieving the revenue guidance, but also in creating a great platform for the future years during the last financial year. Specific to nuclear energy, I do understand there has been a slight pushback in terms of orders being received from NPCI, but they have taken a decision to first experiment on Kaiga 5 and 6 reactors to be given to major companies like L&T, Tata, etc. And the tenders have been floated for them to build the reactors in exactly 4 years' time. But the fleet reactors tenders will continue to flow in. But these 2 reactors, they wanted to ensure that they are done in exactly 4 years, and are they to take 8 to 10 years. The tender has been issued, but MTAR has exclusive capabilities in 14 such packages, which is mentioned clearly in the header as a qualified company. And for these packages, we are expecting close to about at least about 600 crores of orders flowing in the current financial year. And we have estimated on a conservative basis about 500 crores finally that would come in during this year, and probably the rest would come in the next financial year, specific to Kaiga 5 and 6 I'm talking about. And obviously the orders from the other segments which we are very comfortable with in terms of aerospace, clean energy, etc., space and defense. So as I said, these 2 reactors have to be commissioned exactly in 4 years, as mentioned by the CMD of NPCL on a one-to-one meeting with him as well. So as I mentioned earlier, the rest of the fleet reactors will follow the normal mode of operations as the case may be in the past. The next important point which I would like to mention is on the NWC. We have guided for working capital days to be at 220 days, and we have been able to achieve 230 days, down from 290 days in the last quarter. And we are making every effort to bring it down, and this number will come down further this year, and we are targeting 180 days by end of the year, between 180 to 200 days by end of this year. And here again, we were forced to airlift a lot of inconel sheets last year. So we had staggered shipments done by sea, close to about 70 crores of inventory which is in transit, but staggered over a period of time. But we also do have credit terms with the inconel supplier. This we had to do in order to avoid the air freight charges which were phenomenal. So obviously this inventory which we're talking about, 70 to 80 crores, will get consumed over the quarters. It should not be an issue for the company. And that's how we'll further bring down the inventory levels quarter-on-quarter basis to improve our working capital days moving forward as well. The ROC stands at 20% in FY23 as against 14% in FY22. And the ROE in FY23 stands at 18% as against 12% in FY22. And these percentages are expected to even improve further by end of FY24 as well. So quickly, in a brief synopsis, the future outlook for FY22. See, apart from the guidance numbers which I have given, we are in advanced stage to enter into an agreement with Fluence Energy for the energy storage systems, which again comes under clean energy for both domestic and export markets. So over the next 3 years, as we ramp up gradually, starting from FY25 onwards, we are looking at revenues even touching at a level of about 400 crores by end of the third year, starting from FY25. And also, we are entering into various agreements or received orders from companies like Void, GE Renewable, Andrix. Enercon is another company which is really looking at us in terms of wind energy requirements. So this, our fabrication unit, which will be fully commissioned by June 23, will be able to cater to all these requirements. But for Fluence Energy, we have to establish a separate facility for them, which we have. The existing facility can be used for the domestic, but we would like to, we're looking at a huge revenue base, so we would like to look at a separate kind of facility to cater to the Fluence Energy at this point of time. So the most exciting issue is that the Bloom Energy electrolyzers have been installed recently, as probably all of you must have heard. It was done very successfully. And the project, what they have undertaken, was completed in exactly 2 months in delivering an equivalent of over 2.4 metric tons per day of hydrogen output, which is a great stride in terms of production of green hydrogen. So what it means to MTAR is we have been manufacturing the electrolyzers for them. And as I said, systems are established and proven in the market with high efficiencies, which they have proven. We are looking at this vertical to ramp up very quickly, hopefully by end of this year, calendar year, and then this vertical would be as strong as any other vertical that we have today. So we have a very clear, the bigger picture, which I would like to mention for the first time, is that we have a very clear roadmap for MTAR over the next 5 years, by FY28 to be a 3,000 crore company, only through organic growth within its own innovations and manufacturing.
Sorry to interrupt you once again, but we are losing your audio. Ladies and gentlemen, please stay connected while we rejoin Mr. Reddy back to the call. Ladies and gentlemen, thank you for your patience. Your line from Mr. Reddy reconnected, so you may go ahead.
Thank you. So finally, I would say that based on, we have a clear roadmap for MTAR to be a 300 crore plus revenue-based company over the next 5 years by FY28, sustaining its margins through innovation and efficiencies entirely in an organic manner, without considering any kind of any JVs or inorganic growth as far as the roadmap is concerned. And we continue to work towards improving our margins and also trying to expand our customer base, which we have been doing, which is very evident, in which I've mentioned about various customers that we are working with. And this will continue to be our endeavor to have a wide spread of customers over the next 5 years, and in order to ensure that the exposure within each customer is within certain limitations. Thank you so much, and I would like now to hand over the call to CFO, Mr. Gunesh Rao, who will take you through in detail about the financials in more detail than what I have said right now. Thank you.
And thank you, Mr. Srinivas Reddy. Good afternoon, everyone, and a warm welcome to our earnings call. And first and foremost, I would like to express my gratitude for your continued trust and support. I will take you through the financial highlights, post which we will open the floor for questions and answers. Okay. We successfully achieved our revenue guidance with a significant increase in revenues. In FY23, our revenue reached 573.8 crore, representing a growth of 78.2% compared to 322 crores in FY2022. So our EBITDA also showed a substantial improvement in absolute terms, reaching 154 crores in FY23, a 63.1% increase from 94.4 crore in FY22, with a margin of approximately 27%. So though the margins has come down, as Mr. MD Srinivas Reddy explained, reasons for the margin decline, in absolute terms, we maintained a margin of 150 crores as far as the initial guidance is considered. Like FY 2022, 322 crores revenue with a 60% initial guidance at a 30% EBITDA will give us a 150 crores of EBITDA. So same EBITDA we maintained even after the reduction of the margin percentage, but absolute terms we maintained 154 crores as promised initially. Profit before tax at 140 crores in FY23, reflecting a growth of 70.6% from 82.22 crores in FY2022. Similarly, profit after tax increased by 69.9%, reaching 103.4 crore in FY23 compared to 60.9 crore in FY2022. In terms of earnings per share, our diluted EPS for FY23 stood at 33.62, an improvement from 19.79 in FY2022. We have reduced our net working capital days to 230 days, in line with our target of 220 days by end of the FY23. Out of these 230 days, 92 days are related to work in progress. So we aim to further decrease our net working capital to less than 200 days by end of the FY24 through increased turnover, inventory reduction, shorter shipment days, and change in our product mix. Our return on capital employed improved to 20% in FY23 compared to 14% in FY2022. While return on equity increased to 18% in FY23 from 12% in FY2022. We anticipate further enhancement in our returns and ratios through an increased wallet share with existing customers, operating leverage in our product portfolio, and revenue ramp up. We understand the importance of reasonable business practices and sustainable development. Our commitment to corporate social responsibility remains unwavering as we strive to positively impact the communities with which we operate. I also would like to mention that we have strengthened our management team by welcoming Mr. Raj Bollampalli as our new COO. Under his guidance, we expect to optimize our operational efficiencies to cater to the accelerated growth. With that, I open the floor for discussion and welcome any questions you may have. Thank you all.
Thank you very much. Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Deepak Krishnan from Macquarie. Please go ahead.
Hi, sir, and thank you for the opportunity. My first question is largely on your order inflow guidance. You're indicating 1,200 crore order inflow this quarter and about 500 coming from nuclear. So how much would be Bloom's order inflow in the coming year? And because last year we did closer to about 800 crore, and what is the outlook in terms of hot boxes, say, for FY24 and then FY25? Any comments on that you can share?
So can you hear us?
Yeah, we can hear. I think I can hear.
Sorry, Deepak, I was on mute actually. Apologies for that. So, Deepak, I heard your question. The order inflow for this year, which I said is about 1,200 crores, is primarily during the entire financial year. That's how we'll end up with 1,500 crores, is what the estimate is. It's primarily, which I said for Kaiga 5 and 6, we're expecting at least about 500 crores of orders coming in for sure this year. And which I had a detailed discussion with the CMD of NPCL as well on the strategy that what they're adopting right now. And also from the other fleet reactors that we're expecting. And I do understand there was a little bit pushback on the order inflow, but now time has come where clarity is very clear right now in terms of getting these orders through. And obviously the inflows from clean energy segment are not only from Bloom, but we're going to get substantial inflows from various companies where we have done first articles with Voith, Andrix, GE Renewable, and companies like new companies are joining us in terms of Siemens Gamesa, Enertron, etc. And also the strengthening our aerospace vertical. We already received a letter of intent of $10 million from GKN Aerospace. So which we're expecting that to be converted to orders during this quarter or beginning of next quarter. So overall, it's a very nice mix of spread of orders coming in. I've mentioned a conservative number at this point of time, but would expect a lot more orders flowing in. But this would be the bare minimum that we are expecting, and we should stick to this.
And anything coming from Bloom hot boxes shipments for this and next year? Or Bloom overall shipments you're targeting in units?
As of now, so basically we continue to do the Yuma boxes at the rate what we have done. We have done the highest number of boxes in the last financial year, I think close to about 4,500 or 600 boxes. And we will continue to do that, but they are looking at increasing that number, but we have not yet received the confirmation as of now, but we will hear from them by end of this quarter. And as far as Silako is concerned, there are some major design changes which are happening, which that order is still on, which we have to execute. We still have to hear from them officially in terms of what they're going to do in terms of design changes. So that's about 1,600 units we are looking at. But that's something which we need to get, Bloom has to get back to us because they're looking at much higher power generation in change of design or what they want to do with it. We'll know by end of this quarter. So that would be the same number what I've given in the last call as well. And what we are really excited about is the electrolyzers, which now since they have installed it and proven the hydrogen output with very good efficiencies, and we have supplied all the electrolyzers to them. So whatever we are going to do this year, we have an order for 142 numbers. But that's only batch production, but we can see some kind of volume production kicking in probably 2 quarters down the line. So that's where we stand right now.
Sure. Maybe just a question on gross margin. Indicated that mix was one of the factors, but anything that sort of really stood out that is sort of more one-off in nature that goes off, or any cost that is built in for future, revenue? Anything that can take the gross margin back to say 52%, or would we think that say for a full year basis we are in this 48% range next year out?
Not really, Deepak. See, if you look at the absolute numbers, what guidance we have given now. See, the guidance what I've given is I've not even taken revenue guidance. I've not even taken Kilako into picture right now because there are some design changes going on there. So if you look at that kind of revenue guidance I've given, basically the absolute numbers of other segments are substantially going up in the current financial year. So the gross margins would kick in back to about 52-53%, moving forward as well. So that should not be an issue at all.
So maybe just one last question from my end, more on how are we looking at inventory days while you've done a substantial about 20 days improvement in receivables. Largely inventory days and payable days have sort of gone up. So what measures are we taking to get the inventory days back to closer to the 190 odd days which we did in FY22?
Yeah, probably GR will be able to explain that in more detail. But we have put a specific task to reduce the inventory levels. Obviously, I've explained about the internal sheets, what we have done, and that's something which is stock in transit. And also, it is not due as of now. So it will get consumed over the period of couple of quarters. But overall, we are looking at very seriously about getting our inventory levels down as much as possible because we are working on various product mixes to begin with new products being introduced. So over the next 2-3 quarters, we would obviously try to bring them down more and more. And GR, you would like to say something on this?
So actually, the inventory out of 240 crores, 72 crores is a stock in transit, which we may receive after 60 days to 75 days of time. So that is the reason there is an inventory and also payables both are there. So that is one of the reasons. Second, as MD said, these inventories we will use because last time we have airlifted so much of material and the cost is very high. So we are taking a calculated risk and keeping our inventory carrying cost into consideration. We are taking slowly. I think we are trying to reduce by end of this financial year. We will try and maintain 200 crores, less than 200 days of days of working capital. And also this inventory having some of the long lead items for which there is we are working with a nuclear project. We got FMDC, FCS systems. Some inventory, around 25% of the inventory related to that, and around 25% is in stock in transit. Remaining is the export-related inventory, which we will consume in a 4 months or 3 months time. And now that we got some clarity, we are slowly, supply chain issues are relaxing. The clarity we are getting. So normally when we plan the inventory, we have to see that what is the transit times and all. So accordingly, we will plan our inventory days. Suppose sometimes what happens, you may receive in 15 days, 20 days before because of the availability of shipping lines and other things. So these are all the various factors are there. So we have to balance all those things. But definitely, having said that, we are actually working on it. Now we are continuously monitoring on receivables, increasing credit period with my suppliers. So a lot of actions we are taking, and we'll try and reduce as much as possible by end of this financial year.
The WIP days have been closer to 90 days for a lot of time. Do you think it's largely coming from there, or will it come from other than WIP? Will that number go down?
No, WIP is separate number, and which is around 92 days inventory is there, and maximum in that 80% is the domestic where long lead projects inventory. So which is actually good for the company because it is going to crystallize the revenue in the coming this financial year FY24.
Thank you very much. A request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Sandeep Tulsian from JM Financial. Please go ahead.
Very good afternoon, sir, and congratulations on meeting the aggressive guidance.
The line for the participant dropped. We move on to the next participant. The next question is from the line of Renu Baid from IIFL Securities. Please go ahead.
Yeah. Hi, good afternoon, sir, and many thanks for first accommodating the change in the time in the interest of all the investors and analysts. My first question, yeah, thanks much for this. So my first question to you is, you did mention that many materials, especially the inconel steel, is required for exports and other business have to be airlifted, which also impacted gross margins. So can you throw some inputs in terms of why the urgency of airlifting? Were there issues in terms of your normal conventional shipment which was coming through? Because through the year we were maintaining relatively elevated inventory levels. So why the last minute emergency to airlift them and take a hit on the cost as well?
See, there are a couple of issues there. Some were really unforeseen. One is that we import inconel sheets from Germany as well, from VDM. They had a cyber attack and there was an issue with them. So we had issues with them in terms of dispatches. And from the US company, UPM, the initial lot of materials, there are different sizes of inconel sheets. So there was some kind of an imbalance. So in the terms of imbalance, they were delaying because their input raw material got delayed in the United States, and which was not anticipated. So we had to airlift to balance to make sure our production lines are not down. These are the factors. So subsequent to that, it got eased out and they had enough material on hand. We didn't want a situation where we would airlift, especially in inconel sheets, the air freight is very expensive. So
Right.
we absorbed that cost last year, and now we are in a pretty comfortable position in terms of the supply chain, in terms of these inconel sheets, which GR has explained about having it in transit and staggered, which will come in useful for the next 2 quarters without airlifting any material. So
Right.
we had to spend enough money on that last year to absorb that cost.
So can you help us quantify in terms of the fourth quarter gross profit, or what was the impact on raw materials to sales because of this thing? And also, will the cost escalation because of the global vendors will be passed on to Bloom, or we will have to bear the cost for this increase?
We don't have to bear any cost. If there is any increase in the raw material cost, every quarter it is reviewed and it is addressed accordingly. So we don't have to do that at all. In fact, there are a lot of some design changes happening in Yuma as well. For example, we are using 3 war ogre parts for Yuma, which is about $750, which we import. Now they brought it down to 2 with some design changes which we worked along with them. And similarly, any cost escalation is obviously addressed at the end of each quarter, and the PO is amended accordingly. So we are not affected because of the increase in cost as such.
Thank you. I request all the participants, please restrict to 2 questions per participant. The next question is from the line of Amar Maurya from AlphaStreet Advisors. Please go ahead.
So thanks a lot for the opportunity. Just to again continue with this gross margin, sir, was that high cost inventory impacted the fourth quarter margin? That is number one. If yes, what was the quantum of that high cost inventory which got baked into the fourth quarter margin?
I think JR can explain this, but I would like to brief this. JR can explain this.
See, the gross margin drop alone we should not see here. Just because the gross margin is good, it doesn't mean that the EBITDA will, suppose say today we are at 46%. So if it is 54.8%, EBITDA will not increase. So there are some products like exports, for example, where the inventory is 60%, we have a gross margin at 40%, whereas the value addition requirement is very low. In case of domestic project, gross margin is higher and value addition is higher. So in our company, since we are in various segments, the gross margin alone is not required to be seen. The EBITDA decrease is not, as our MD said, it is not just because of the domestic sale and because of export. It is not that. There is a one-time correction we have done in line with the market benchmarking to our employees. So where our cost is impacted, so the fixed cost is impacted. That is the reason for the lower EBITDA margin, not because of the gross margin lower and all. If the gross margin is lower and valuation will be higher in the domestic projects and vice versa for the export products.
No, sir, I'm confused. Basically, what I'm trying to understand, your gross margin has gone down by 400 basis points. Your EBITDA has gone down by 300 basis points. In sequentially, I'm talking about sequential, Q3 to Q4. So basically, what I'm trying to understand is 48% gross margin, which we have reported in this quarter. Is it there is some one-time RM impact into this? And are you saying that from Q1 again the gross margin will bounce back to 52%? That is what I'm trying to understand.
Okay, can I explain this here?
Yeah.
We can continue. See, basically in Q4 our product mix was more towards the exports than domestic, where the gross margin is lower in exports. But the operating leverage technically has eventually, as I explained to you, if not for the employee benefit expenses, we could have maintained our EBITDA margins, right? Now, as I said earlier, moving forward, our product mix, where I said that even the domestic is going to be reasonably on the higher side. So we'll bounce back, as I've mentioned to Deepak as well, that we'll go back to 50-53% moving forward, based on the product mix that we're going to have over the next few quarters.
Thank you. The next question is from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Yeah. Congrats on a decent set of numbers, sir. So first question on the revenue guidance and this number. What is the revenue guiding for FY24?
Can you repeat that?
On the revenue guidance, how much you are expecting in FY24?
Mohit, your voice coming little muffled. Is it possible for you to speak through the handset, please?
Hello, am I audible now? Audible now?
Yeah, absolutely. Yeah, you are now.
So my question is on the revenue guidance. How much you are expecting in FY24?
I've already mentioned that.
I missed out, sir. Mr. Number.
Okay, sure, no problem. So we're expecting a 45 to 50% increase in revenue guidance for FY24.
Okay. My second question is on the working capital. While you're guiding for a improvement in the entire fiscal, can you expect some improvement in the first half itself by the time you report a number in September?
JR, you want to answer?
Yeah, we are trying to reduce, but as we said already, there are some inventories which existing inventories we will use in for the first half of the year, and third quarter requirement we try and get as per the need basis. So we'll try and reduce our working capital by first half of the year.
Last question is, can you speak about the new clients you added in FY23? And how do you expect the ramp up in revenue and the opportunity in FY24 and FY25 from the new clients, especially?
See, we have added a number of new clients, which I've said, starting from Voice, GE Renewable, Andrix, Hitachi. Now we've added Thales, GK Aerospace. So we are improving our customer base with a very wide portfolio right now. So we have more or less completed first articles with some of the customers, and some are in progress. And also the new customers like Fluent Energy, Enervenue, and all these customers are almost in the final stage of discussions. So all these customers in engineering, once we have done with the first article, the volumes will pick up. Especially our fabrication is also getting fully commissioned by end of June, including the machining aspect of it. And Enercon is another company which is they are looking at us to take care of their needs for rotor and stator, very complicated assemblies that they're looking at. So all this over the next 2-3 years would become a substantial business for MTAR. As I said, including Fluence, and take all these customers into account, including GK Aerospace in the aerospace sector. We're looking at revenues probably by end of 3 years, we're looking at 600 to 700 crores of revenues kicking in from all these customers, or even more.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. Next question is from the line of Vinod from Union Mutual Fund. Please go ahead.
Yeah, thank you for taking my question, sir. Sir, I just want to have your comment. There was a Indian space policy which was approved by the cabinet in the month of April. I just would like to get your comment on that, and also if you can just help me how MTAR will benefit from this policy.
Can you repeat that once again?
So there was a Indian space policy which was approved by the cabinet for the which was talking about institutionalization of private sector participation in the space sector. I would like to get your comment on how MTAR will benefit from this policy.
See, so you're talking about, this is exactly what I'm saying. See, if MTAR is getting involved in design and development of its own launch vehicle in the small satellite launch vehicle, so ultimately the government is looking at privatization in the space sector in a big way. But for any company to design and develop, that's what I said, it's a 4-year period which we have already taken it up very seriously, and we have actually completed a lot of design work. As we move on, we have already recruited very well experienced scientists in this area. So this is something which is going to be a game changer for MTAR 4 years from now. That's going to be a fully integrated system, and our first developmental flight should be ready at the end of the 4th year. So this is what the government is looking at. But again, the government has also given the PSLV launch vehicle to private companies like L&T and HAL in consortium. But there again, since MTAR is the exclusive supplier of the liquid propulsion engines and various other modules that we supply for them, which they have been using for all their launch vehicles. So these vendors again would come to us to deliver the engines to them as well. So we benefit in both ways, but we would like to ultimately develop our own product within the company moving forward. So that's pretty encouraging, and it all depends on how we design and develop our own products over the years.
Okay. And just a second clarification, you said that in the clean energy business, the new clients like Voigt and GE and Siemens are expected to contribute 600 crores over the next 3 to 4 years. Currently, is there any contribution on the revenue side or order backlog from this new client?
No, we have orders. We already executed some orders. See, that's what I said. We started doing first articles. I think we have executed some between 15 to 20 crores of orders, or even more than that for them. So it's a starting point. So this is in engineering. First, we do the first articles, then the customer starts building up, and slowly have to ramp up and take care of their requirements. And Fluence is something which we have yet to start. We are almost in the final stage of discussions right now. And that's something the energy storage systems and the clean energy is going to ramp up in a big way over the next 3 years on a step-by-step manner. So overall, the vision of the company is to diversify a very strong customer portfolio and also have enough revenues being generated from each of these customers. So we've been very careful in dealing with that, because in engineering, we spend a lot of time in developing these products for them or developing whatever their requirements are. But we also look at the commercial aspects in terms of how much of revenues that we can generate on volume terms moving forward. So we are in line with that target. That's how we are able to I've clearly said that the vision of MTAR is to be a 3,000 crore revenue-based company by FY28. And a lot of work has been done in the last financial year, which does not reflect in your numbers, obviously. But this is a path forward as a platform being created year-on-year basis to achieve our end goal of sustaining those revenues and the margins what we're looking at.
So that's very helpful. Thank you, sir, and all the best for your future journey.
Thank you.
Thank you. Next question is from the line of Dipesh Agarwal from UTI Asset Management. Please go ahead.
Yeah, good afternoon, gentlemen. My first question is on order inflow. You are guiding for some 1,200 crores of inflow next year, of which 500 is from nuclear. If I do the math, it implies that we are building in a decline in the other segment order inflow. Last year, clean energy itself was 800 crores. So what explains this kind of an estimation?
Good afternoon, Dipesh. See, I have given a conservative estimate, Dipesh. So whatever I said, 1,200 crores is what I've said, but obviously we'll get a lot more orders in clean energy segment as such. But at this point of time, I've given a very conservative estimate as far as the order book is concerned, which is substantial actually. But we would probably get much more than that. But I would like to always, the way I tell things, that I would like to maintain a number and try to achieve it much more than what I say. So that's what it is. So obviously you're right. We'll have a much stronger order book moving forward as well.
Understood. The second question was on the working capital side. If I look at the working capital, there seems to be a significant increase in payables this quarter. So is there a change in the terms with our vendors?
I quickly answer. Jia, do you want to answer this because of the...
Yeah, the payable days, because 72 crores of raw material is in stock in transit, and the same thing is reflecting in the payable also. That is another reason. And some other thing is we are actually talking to various customers and increasing our credit periods. Earlier we used to pay advances. Slowly we are bringing into 30 days, 45 days. Some customers, some suppliers even 60 days also. So we are trying in the both sides, but there is a stock in transit value is also included in this payment.
Understood. Related question. So earlier you had highlighted that in terms of receivables, the transit time to US had increased, which actually meant your receivables from Bloom had increased because they pay after they receive the shipment. Now, what is the situation? And globally, the shipment timelines are shrinking.
I think it is stabilized now.
Yeah, it is stabilized. That's why actually last time it was 154 days, now 132 days now. Last year it is 154 and now 132 days. And we are closely monitoring and try to get as much possible. And in case of Bloom, there is no follow-up required. It is actually on due date, it will come without any intervention. They have a supplier portal wherein we will know when it is reached, when they are paying all those things.
Thank you very much. The next question is from the line of Bala Murali from Oman Investment Advisors. Please go ahead.
Yeah, good afternoon. So, earlier, 2-3 years before, I have gathered for 8,000 hot boxes.
Bala, your voice is not coming clear and there is a slight background noise. Is it possible for you to come to a different location?
Yeah, now is it okay?
Yes, thank you.
Yeah, earlier in maybe 1 or 2 years before, we have guided for 8,000 FAFC boxes capacity by FY24. So are you on track? We can deliver if the order is available, 8,000 FAFC boxes?
So it's, I've said 7,200 hot boxes, including all the models put together. So we are on track with it, except Kilako, some design changes are going on, which is about 1,600 units, which we'll know by end of this quarter. Once that clarification comes from Bloom, then probably we will be on track with that as well. Or probably they'll increase the other units as well. So we'll know by end of this quarter.
Yeah, thank you. And the second one is regarding this electrolyzers. So what could be our capacity for the FY24, and how much we can deliver if orders are available, and then average realization for this electrolyzers?
So as I said earlier, electrolyzers, they've already established the project in US where they were able to successfully commission it and display it to all their customers, which is happening as I speak. So based on the initial feedback I have, it's been highly successful in terms of the efficiencies and what they have done. So hopefully in a couple of quarters we will see a good ramp up happening, and we have the capacity to handle it. And the ramp up, obviously, if the volumes really pick up as UMAs and things like that, probably then we need to look at, we proactively look at capacities and then we act accordingly. So we'll address that once we cross the bridge at that time.
And average realization, any ballpark number?
It's around, as of today, it's around roughly around $23,000.
And lastly, I think you have given the 4 to 5 years guidance. I missed that number. I think it's 3,000 CR or something else.
Yeah, that's right. What I've said is we have a clear roadmap in terms of how we are creating a platform and building a customer base year-on-year basis, and the kind of revenue growth we're going to consistently have, sustaining our margins. Over the next 5 years, we should be at that level of 3,000 crores is our roadmap 5 years from today.
Yeah, that's all, sir. Thank you. Thank you.
Purely on organic way.
Yeah, sure. Thank you, sir.
Thank you. Next question is from the line of Sriram Kapoor from Prabhudas Lilladher. Please go ahead.
Hi, thanks for the opportunity. I wanted to ask you about your defense segment and how you see that growing over the next few years, and what within defense, what sector do you specifically cater to? Is it directly supplying to the armed forces, or do you supply to the BPSUs like HAL? So if you could give some color on that.
Absolutely. So as far as defense is concerned, our percentage is very low, but our focus has been primarily on clean energy segment, and nuclear is also part of that, and space areas. But we are doing substantial work for the defense labs as of today, and that's what we are doing right now. But in order to cater to the air forces and navies of the world, the issue is we need to have the defense license, which we probably by this quarter we'll have the defense license with us. It's a long and tedious process to get such defense licenses, so we are trying to get that, which will have it right now. But once we have that, then in terms of technology and supplying the end systems, obviously we need to collaborate with some of the MNCs, which we have to see how profitable that is to the company, which we are very clear in terms of maintaining our margins, because most of the MNCs would try to pull away as much of share from the whole projects what they get in terms of make and buy. So we are evaluating all these things. So if you have a good lucrative opportunities, we'll look at it, but primarily our focus is more on these other areas what we're looking at right now.
Understood. Thank you. And my next question is on the key products that you have under development, which is your valves for defense and the semi-cryo engine and the import substitute like the bellows and heaters. What is the outlook for them? What is the addressable market for these products, and when will they begin to contribute significantly to your top line?
See, the products, as you say, the electromechanical actuators, we are delivering this year. All the orders, what they've given us, which we have taken it for the first time, they're all import substitute products. We are delivering almost 7 to 8 crores of EMAs this year. That's going to be a substantial achievement in terms of delivering the actual product which they're going to use instead of importing it. Roller screws, we have already proved to DRDO about our capabilities, which are importing from Rollvis, Sweden. So the formalities are pending in terms of getting an official note through in terms of Government of India to put an import ban. We are hoping that will happen by end of this quarter. So that's going to be a substantial product which we have taken 1.5 to 2 years to develop it. For the last 30 years or 35 years, they have been importing it from Sweden. So that should stop. So with the progress what we have made here. And bellows is something which we've already started and using it as well in-house right now. We look at other opportunities where we can also make bellows for other customers as well, that's another big market that we are looking at, but that we have to seriously look at it, because right now we are busy in our own in-house consumptions for bellows. Heater is another thing which we are working upon. Ceramics, the components what we are using in-house is also something which we are developing right now. So a lot of these products, and as I said, the ASP is another product which we got commissioned and we got qualified and we started dispatching as well. So last year we did 7.5 crores and this year we'll do close to about 110 to 120 crores of ASP dispatches happening this year. So our idea is to really increase our product portfolio basket over the next 3-4 years to make it a much larger revenue base, which is a high margin area for us at this point of time.
Okay, got it. Thanks a lot. And just last one bookkeeping question on if you could provide the revenue split for Q4 FY22 between space and defense, because last year in the presentation they were clubbed together at about 15.2 crores. So if you could provide the split first between space and defense.
JR, you want to? I think defense is a very small percentage.
Yes, defense is only 3%. Space, we have not included any defense revenue.
In Q4 FY22, so that's last year's quarter. So that 15.2 crores is purely space? There's no defense in that?
There is hardly any percentage. Defense is less than 3%.
Okay, got it. Thank you so much. Really appreciate it.
Thank you.
Thank you. A request to all the participants, please restrict to 2 questions per participant. Next question is from the line of Sanjay Satapathy from Ampersand Capital. Please go ahead.
Yes, sir. My first question is that you have given this salary hike suddenly in Q4. How much of that has gone to top management? Can you please give that bifurcation?
Most of it has gone towards the highly skilled employees, the shop floor workers who have been working with us for quite some time, because these are the workers with a lot of experience, and also the core engineering team. So the focus was primarily on that, not on the top management as such.
Understood. And sir, this is something which you could have planned for. So considering that you had given a guidance in February and you ended up this expense, so just wanted to see whether anything suddenly changed for you, and more importantly, is there some kind of a process-related deficiency there in the system that you are incurring many expenses which is coming out of turn?
This is not an out-of-turn expense. See, it is nothing to do with process-related issues. It was a decision taken looking at a very conscious decision taken, looking at the future outlook of the company, which is only going to benefit the company and the shareholders in the long run. Obviously, it has an impact on the P&L, but it is something, if you're investing in CapEx, you also need to look at looking at your own team of people who are working for the company for years. And we felt that this, genuinely this is an appropriate time. When we look at the roadmap for the company over the next 5 years, we really felt that this is a great motivation factor moving forward. And that really doesn't really matter in terms of long-term basis. So it was a genuine decision taken which only benefits the company and the shareholders moving forward.
Thanks. My last question is, you're getting into quite a few new product areas, looks like in financial year 24, including valves and some other application. I assume that those will be far more better in terms of margin. But how difficult will it be for you to scale up in this category?
No, we have enough capacities. It's not that. It's all about the developmental activities, right? So MTAR has got enough capacities across the board. We have enough machines and, as I said, the highly skilled employees of the company. They are the core strength of MTAR. So the capacities are never an issue unless any bottleneck areas or any specific area where we need to build the capacities separately, which are not part of the existing capacity, then it's a separate issue. Otherwise, it's not a major concern at all.
Okay, got it. Thanks a lot.
Thank you. Next question is from the line of Anika Mittal from Invest Research. Please go ahead.
Hello.
Yes, Anika, you're audible. Go.
Congratulations.
Yes, good afternoon.
Hello, am I audible?
Yeah, you're audible. Please go ahead.
Yeah. So my question is on the EBITDA margins. EBITDA margins in financial 21 was 34% approx, and financial year 22 it was 29%. And in this financial year it came down to 27%. So from 34% to 27% in 3 years. What's the reason for this growth? And what will be the sustainable EBITDA margins in next, say, 2 or 3 years?
I've already said that, one is sustaining the margins. We have taken various steps and we will sustain these margins moving forward. And the product mix also has changed year-on-year basis. Like when we're looking at the product mix is also very important. So we have considered that we're moving forward as well. So we'll be able to maintain such margins moving forward, what I've said earlier in my speech as well.
All right. So my next question is on a deal. FT Technology has partnered with SFT Energy, hydrogen and methane fuel cells manufacturing in India, for which they have planned to set up a factory program. How do you see this deal as an opportunity going forward? Like can we add FT Technology as our customer?
No, we can have anybody as a customer. It is not about India abroad, right? First of all, most of the hydrogen sector electrolyzers are in the developmental stage. You have OMIUM, for example, trying to develop an electrolyzer.
Hello. Hello. Hello.
The next question is from the line of Amar Maurya from AlphaStreet Advisors. Please go ahead.
Sir, just one clarification. This low-cost inventory, basically the current inventory of 74 crore, is there any inventory of airlift inventory into that?
No, the 74 crores which is in transit is by sea only. That's what we have clearly mentioned. There's no airlift factor there.
And all airlift inventory is basically, do we have some airlift inventory left?
We don't have anything. We have used that up. Otherwise, why would we airlift it? We wouldn't do it, right? So if we have the time, then we'd rather move it by sea. So
okay. And this, sir,
we have taken that impact already in the last quarter.
Got that. Got that. And then, sir, the gross margin recovery will happen in first half or in second half?
No, the recovery will happen as we move on in the first half itself. That's not an issue at all.
Okay. Thank you, sir. Thank you. Thanks a lot.
Thank you. Next question is from the line of Pradyumna Chaudhary from JM Financial. Please go ahead.
Yeah, hi. So my question was more regarding the green hydrogen space in India. So we are seeing a lot of developments there, a lot of players talking about it. So what opportunities do you see for your company in this particular space in terms of the kind of products or components we can be manufacturing here? And are we in talks with any major players?
Yes, we are. But see, the issue, as I've explained earlier, even for Bloom, it took quite a while to actually establish, and they proved recently in the last 1 week what they can actually generate output for hydrogen at very high efficiency. So it's all technology based. So as I mentioned earlier, depends on all these companies where they can build a proper electrolyzer with a lot of efficiencies to bring down the cost of hydrogen. Then it makes sense. So we have to see how it goes. So obviously MTAR is there and has the capacities to address such situations. So probably we have to see over the next 6 to 8 months how it evolves and how they can develop these electrolyzers.
But what all products in the value chain can we be looking at? One would be electrolyzers. What else?
No, the electrolyzer is the main thing, the entire electrolyzer. We have the facilities and the technology to build for them, whether it is PEM or SOFC, whatever it is. End of the day, it's the entire electrolyzer, the design part of it, which has to work for them. Because it's their design, it's not our design.
Thank you. Next question is from the line of Bhavan Shah from AlphaStreet Advisors. Please go ahead.
Yeah, sir. My question is again on the gross margins front. So you mentioned that the last quarter we did some airlifting for the raw mat. So can you share the airlifting cost, which is the extraordinary in nature for the last quarter?
I think it's probably close to about 7 to 8 crores of material that we had to airlift, the cost that we had to airlift. Roughly, I'm talking. I don't have the exact number to be genuine, but I think to my knowledge, it's about that number.
Yeah, it's around $4-5 lakh. That is the value. What you are saying is inventory value, no? You're saying?
Yeah, airlift.
Overall, he's asking about the airlift cost. So
Okay. So total is around that 7.
that's about 800,000 something, right? So
Correct. The total cost is that much, yes.
yeah.
Okay. And the second one is on the the net working capital days. So in the presentation you mentioned that roughly 138 days is other than WIP, which must be having some finished good inventory also. So can you share out of 380 odd crore the inventory, which is how much is the finished good, and post you also mentioned that some the part will be supplied for NPCL in the first half itself. So how do you see the WIP days going forward, or maybe the inventory days? Because I think these 200 days will fall down to what level for FY24?
See, total 380 crores of inventory, 144 crores is a WIP and 242 crores is a raw material. And out of 242, 72 crores is a stock in transit, which is actually both reflecting in the inventory and the payables. So by end of the year, we try to make reduce inventory, like next 2 quarters, this raw material, whatever we are importing, whatever is imported and whatever is in transit, which we will use it in the 1 or 2 quarters. And after that, slowly we will try to reduce as per the requirement at the operations. So that's why thereby we can reduce the inventory days.
Sure. And one thing is, the clean energy contribution for this quarter is roughly 73% versus the Q3 contribution was 80%. So how is the gross margin differentiation? You already mentioned that the export business is doing a lower gross margin versus the domestic one. So what is the difference between export and domestic gross margin?
So in the exports, there is around 40% gross margins are there. In case of domestic, around 60%, 55 to 60% gross margins are there. In some cases, we have various projects. Some are having even 30% also. Some are at 55 also. So around, you can say gross margins around 60% in case of domestic turnover.
Thank you. A request to all the participants, please restrict to 2 questions per participant. Next question is from Sandeep Tulsian from GM Financial. Please go ahead.
Yeah, sorry, sir, I got dropped earlier. First question is pertaining to the Bloom Energy guidance. I think the company itself has given guidance of about $1.35 billion for product revenue, which is 50% higher. So in that contrast, our guidance for the year, where we are ramping up other segments as well, nuclear energy and the others, seems to be a bit on the conservative side. So if you could highlight more on specifically how much you're building in terms of the guidance for clean energy segment and how much for the overall other segments as well for FY24, that is space and nuclear energy.
So Sandeep, basically I've taken 55% or so for clean energy, which is very conservative. You're absolutely right. But I would like to stick to this guidance for now, 45 to 50%. The good news is that the other part of the 45% is definitely going to happen. So that absolute number is going to really, give a lot of difference in terms of our margins as well. So what the kind of work we have done over the last 1 year or 2 years. So obviously it's a conservative guidance, but I would like to stick to that. I do understand that Bloom Energy has given a guidance of 1.4 billion as compared to 1 billion last year. So let's see how it goes. We'll have more clarity by end of June. Obviously, the new orders will be placed, as you know, Sandeep. Last year also they did that for the next year as well, the last quarter. So we'll see how it goes. June, July, we'll have more clarity on that.
Fair enough. And just one clarification regarding this GKN Aerospace $10 million order. Is it already booked and shown in our product segment, or it is something that came after 31st March?
It came after 31st March, so they have given a letter of intent to us, so I can't take that into the order book as of now, right? So they've asked us they've given us to go ahead with the raw material sourcing and all that. The order will come in probably in this quarter itself. The official order will come in this quarter itself. And that's something they have done a lot of due diligence before they release that order to us. their LOI to us. So similarly with Thales as well. So these are all the things, the stepping stones for our future growth. We are trying to diversify to different customers, different segments, and things like that, where our profitability is even much higher. So that's what we're looking at.
So then, as a follow-up, what is this big order book build-up of product segment? If you could just clarify on that, because this is a huge jump that we see on a year-on-year basis.
Yeah, see, the product, you're talking about the product portfolio, right?
Product segment. Yeah,
one is we are looking at the electromechanical actuators. The second is the roller screws. The third is the ASPs, which we are going to do more than 100 crores this year. We just got qualified in the last quarter of this last financial year, and we dispatched about 7.5 to 8 crores worth of products to them. And then now we are ramping up. The ramp up has already started, and we'll be achieving more than 100 crores of that revenue. So I have not taken into consideration a lot of the other products that we are doing, like roller screws and all that, which will really, now we're almost there to get qualified there. It's taken a little while because of the various issues with, how to prove to the RDO and all that, but finally we have achieved that. So all these things will accumulate and will result in revenue increase over the years.
Thank you very much. Ladies and gentlemen, due to time constraint, we'll take that as the last question. I now hand the conference over to Mr. Srinivas Reddy for closing comments.
I would like to thank everyone for joining our earnings call for FY23 Q4 earnings call. And I hope I've explained very clearly about the margins and revenues and the future outlook of the company. And I really appreciate the support from all the shareholders to MTAR, and we are right on track. And we believe in giving a guidance which we would like to adhere to, and we have done that. And I also explained very clearly about the slight reduction in the EBITDA margins for Q4. And moving forward, we'll get back to the normal margins what we have been delivering. And please address this on an annualized basis. Whatever we do, we'll definitely achieve the margins what guidance we have given moving forward as well. Thank you so much.
Thank you very much. On behalf of MTAR Technologies Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.